I'm George Soros. I've been investing for over 70 years and I'm worth about $7 billion. People always ask me how I made my fortune. They want to know the secret strategies, the insider information, the complex theories that led to my success. But the truth is much simpler and much more uncomfortable than they expect. I got rich by doing the opposite of what everyone else was doing. When the crowd was buying, I was selling. When the crowd was optimistic, I was pessimistic. When the crowd was certain about the future, I was betting against that certainty. In 1992, when every economist, every central banker, every financial expert said the British pound was strong and stable, I bet $10 billion against it. The crowd called me crazy. The Bank of England called me irresponsible. The media said I was destabilizing the economy. But I made over $1 billion in a single day because I was right and the crowd was wrong. During the dot-com bubble, when everyone was convinced that internet stocks would go up forever, when taxi drivers were giving stock tips, when people were quitting their jobs to day trade, I stayed away and I was called old-fashioned, out of touch, someone who didn't understand the new economy. But when the bubble burst, I was one of the few who didn't lose everything. In 2008, when everyone believed that real estate always goes up, when people were buying houses they couldn't afford, because this time was different, I positioned against the housing market. Again, I was criticized. Again, I was called a pessimist. But again, I profited when the crowd was destroyed. Here's what I've learned after 7 decades. The crowd is wrong at every major turning point. Not sometimes, not occasionally, every single time. The crowd buys at the top, sells at the bottom, and loses money systematically because they follow emotions instead of analysis. But here's the uncomfortable truth that most people don't want to acknowledge. The crowd isn't just wrong about markets. They're wrong about wealth building, career decisions, life choices, and almost everything that matters for financial success. Following the crowd is the fastest way to stay poor. Today, I want to show you why this happens, how to recognize when you're following the crowd, and most importantly, how to develop the psychological independence necessary to get rich. Because here's what the financial industry doesn't want you to understand. Wealth transfers from the many to the few, from the crowd followers to the independent thinkers, from the emotional to the analytical. The question isn't whether you're smart enough to get rich. The question is whether you're brave enough to think differently from everyone around you, even when it's uncomfortable, even when you're criticized, even when you doubt yourself. Because I promise you this, if you keep following the crowd, you'll get the same results as the crowd, and the crowd never gets rich. Why the crowd is always wrong at critical moments? The fundamental problem with crowds is that they amplify emotions and suppress rational thinking. When people come together in groups, especially when money is involved, they stop thinking independently and start following the emotional energy of the group. Fear becomes panic, greed becomes euphoria, and uncertainty becomes false confidence. This is my theory of reflexivity in action. Market participants' perceptions influence market reality, which in turn influences their perceptions, creating feedback loops that push prices far away from fundamental values. The crowd becomes a self-reinforcing mechanism that creates exactly the opposite of rational decision-making. During the 1990s technology bubble, I watched this process unfold in real time. Initially, some internet companies were genuinely innovative and had real potential value. But as more people invested and prices rose, the rising prices themselves became justification for even higher prices. People stopped analyzing whether companies had viable business models and started buying simply because prices were going up. The crowd convinced itself that traditional valuation metrics didn't apply to internet companies. This time is different. They said the internet changes everything. They said the crowd created its own reality where losing money on every transaction was somehow a path to eventual profitability. But reality eventually reasserts itself. Companies that don't generate profits eventually fail. Prices that have no relationship to underlying value eventually collapse. The crowd's collective delusion ends in collective destruction, and wealth transfers from the believers to the skeptics. The same pattern repeated during the housing bubble of the 2000s. People convinced themselves that real estate was different, that the houses always appreciate, that you could never lose money in real estate. The crowd ignored fundamental questions like how can house prices rise faster than incomes indefinitely. Instead, they focused on prices that kept rising and convinced themselves that rising prices justified even higher prices. Understanding this pattern is crucial for wealth building because it shows you that the crowd's confidence is actually a danger signal. When everyone agrees that something is a great investment, when criticism is dismissed as ignorance, when prices rise simply because prices have been rising, these are warning signs that you should be moving in the opposite direction. Historical patterns of crowd behavior. My experience spans multiple generations of market cycles, and the patterns of crowd behavior are remarkably consistent across different eras and different asset classes. Understanding these patterns helps you recognize when crowd behavior is driving prices away from reality. The first pattern is the transition from skepticism to acceptance to euphoria. In the early stages of any major market move, there are always skeptics who question whether the trend can continue. But as prices continue rising and the skeptics appear wrong, public opinion gradually shifts toward acceptance and then toward euphoria. During the Japanese stock market bubble of the 1980s, I watched this exact progression. Initially, rising Japanese stock prices were justified by genuine economic growth. But as prices continued rising beyond any reasonable relationship to earnings, the justifications became increasingly elaborate and disconnected from reality. The crowd convinced itself that Japan had discovered a new form of capitalism where traditional valuation metrics didn't apply. By the peak in 1989, the total value of Japanese stocks exceeded the total value of all US stocks, despite Japan having an economy half the size. The crowd had completely lost touch with reality, and when the bubble burst, Japanese stocks fell 60% and took decades to recover. The second pattern is the dismissal of warning signs and the persecution of skeptics. During bubble periods, anyone who questions the crowd's beliefs is labeled as ignorant, outdated, or motivated by jealousy. This social pressure reinforces the crowd's beliefs and eliminates contrary voices that might introduce rational analysis. I experienced this personally during the dot-com bubble, when my cautious approach to internet stocks was widely criticized. Financial media portrayed me as an old-fashioned investor who didn't understand technology. But this dismissal of skeptics is actually one of the most reliable indicators that crowd behavior has reached dangerous extremes. When the legitimate questions are met with ridicule rather than analysis, when critics are attacked personally rather than addressed intellectually, you know that rational thinking has been replaced by emotional momentum. These patterns repeat because human nature doesn't change. The specific assets, technologies, and economic conditions may be different, but the psychological dynamics of greed, fear, social pressure, and rationalization remain constant across generations. Recognizing when you're following the crowd, one of the most difficult aspects of building wealth through independent thinking is recognizing when you're unconsciously following crowd behavior. Most people believe they think independently, but social influence is largely unconscious and affects even people who are aware of its existence. The first indicator that you might be following the crowd is when your investment decisions align perfectly with popular opinion and media coverage. If everyone you know is excited about the same investments you're excited about, if financial media coverage supports your positions, if social media is full of success stories about your investment strategy, these are warning signs. During the cryptocurrency boom of 2017, I watched millions of people convince themselves they were independent thinkers while following identical crowd behavior. They read the same articles, followed the same influencers, repeated the same arguments, and made the same mistakes. They thought they were rebels challenging the traditional financial system, but they were actually following very traditional bubble psychology. The second indicator is emotional decision making disguised as rational analysis. When you find yourself creating increasingly elaborate justifications for positions that aren't working, when you dismiss contrary evidence as biased or outdated, when you feel anger toward people who question your investment thesis, these are signs that emotion rather than analysis is driving your decisions. The third indicator is fear of missing out driving your investment timing. If you're buying assets because you're afraid their prices will rise without you, rather than because you've concluded they're undervalued, you're following crowd psychology. Investment decisions should be based on analytical conviction, not social pressure. The fourth indicator is overconfidence in predictions about the future. Crowds always believe they can predict the future with great accuracy, especially during bubble periods. If you find yourself certain about how events will unfold, especially in complex economic situations, you're probably following crowd delusions about predictability. To develop genuine independence, you need to actively seek out contrary opinions and force yourself to articulate why those opinions might be wrong. If you can't make a strong case against your own positions, you probably don't understand them well enough to hold them with conviction. Developing genuine independent thinking. Independent thinking isn't just about disagreeing with popular opinion. It's about developing the analytical and psychological tools necessary to reach your own conclusions based on evidence and logic rather than social pressure and emotion. The first step is accepting intellectual humility. You must acknowledge that you don't know everything, that you can be wrong, and that changing your mind based on new evidence is a strength rather than a weakness. This humility is essential because it keeps you open to information that contradicts your current beliefs. Most crowd followers are intellectually arrogant. They believe they've figured out the secret to wealth building, that they understand markets better than experts, that they've discovered opportunities that everyone else has missed. This arrogance makes them immune to contrary evidence and ensures they'll hold losing positions far too long. The second step is developing systematic analytical processes that don't depend on emotional reactions or social validation. This means creating checklists, decision frameworks, and review processes that force you to consider multiple perspectives and scenarios before making significant financial decisions. For investment decisions, this might include requiring yourself to write down the bear case for any investment you're considering, seeking out and seriously considering contrary opinions, and establishing specific criteria for when you would change your mind about the position. The third step is understanding your own psychological biases and emotional triggers. Everyone has cognitive biases that systematically distort their thinking in predictable ways. Recognizing these biases in yourself allows you to compensate for them and avoid the worst decision-making mistakes. Common biases that lead to crowd-following behavior include confirmation bias, seeking information that confirms existing beliefs, availability bias, overweighting recent events, and social proof bias, assuming that popular opinions are more likely to be correct. The fourth step is developing tolerance for uncertainty and discomfort. Independent thinking often requires holding positions that feel uncomfortable, maintaining opinions that aren't socially popular, and accepting that you might be wrong about important questions. Most people follow the crowd, because it provides psychological comfort. When everyone agrees with your decisions, you feel validated and confident. When you disagree with popular opinion, you feel isolated and uncertain. But this discomfort is often a signal that you're thinking independently rather than following social pressure. The psychology of wealth transfer. Understanding how wealth actually transfers from the many to the few is crucial for positioning yourself on the winning side of this process. Wealth transfer isn't random-minded. This follows predictable psychological patterns that reward independent thinking and punish crowd behavior. The fundamental mechanism of wealth transfer is that emotional investors systematically buy high and sell low, while analytical investors do the opposite. This happens because crowd psychology creates predictable patterns of greed and fear that sophisticated investors can exploit. During bubble periods, crowds bid asset prices far above reasonable values because they're driven by greed and fear of missing out. Independent investors sell into this euphoria, converting overpriced assets into cash that can be deployed when prices collapse. During crash periods, crowds sell assets far below reasonable values because they're driven by fear and panic. Independent investors buy during this despair, acquiring underpriced assets that will recover when emotions stabilize. This process transfers wealth from emotional participants to analytical participants over multiple market cycles. The crowd provides liquidity to sophisticated investors at exactly the wrong times, minus buying when they should be selling and selling when they should be buying. During the 1970s, when inflation was destroying the purchasing power of traditional investments like bonds and savings accounts, most investors continued holding these safe assets because they were familiar and socially acceptable. Meanwhile, independent thinkers moved into inflation hedges like real estate, commodities, and foreign currencies. The wealth transfer was enormous. People who followed conventional wisdom about safe investing lost 50% of their purchasing power over a decade, while those who understood the inflationary environment and positioned accordingly preserved and grew their wealth significantly. The same pattern occurred during the technology revolution of the 1980s and 1990s. Crowds initially dismissed personal computers, the internet, and mobile communications as toys or fads. By the time these technologies became obviously important, most of the wealth creation had already occurred for early investors. Understanding wealth transfer psychology helps you recognize when these opportunities are emerging. They are typically characterized by mainstream skepticism, limited institutional participation, and prices that don't yet reflect long-term potential. Practical implementation of contrarian strategies. Implementing contrarian investment strategies requires specific techniques and mental frameworks that help you identify opportunities and maintain discipline when social pressure is pushing in the opposite direction. The first technique is sentiment analysis. You need to develop methods for measuring crowd sentiment and recognizing when it reaches extremes that signal opportunity. This includes monitoring financial media coverage, social media discussions, and institutional positioning data. During the dot-com bubble, useful sentiment indicators included the number of technology IPOs per month, the percentage of technology stock coverage in financial magazines, and survey data showing individual investor beliefs about technology stocks. When these indicators reach extreme levels, that everyone is bullish, no one can imagine prices falling, skeptical voices are completely dismissed. This is often a signal that contrarian positioning will be profitable. The second technique is fundamental analysis that ignores current market prices and social opinion. You need to develop independent methods for valuing assets based on underlying economic realities rather than market sentiment or momentum. This might involve analyzing cash flows, competitive positions, regulatory environments, and long-term demographic trends without reference to current stock prices or popular investment themes. The goal is developing conviction about fundamental value that can withstand social pressure and temporary market movements against your position. The third technique is systematic position building and risk management. Contrarian positions often involve significant timing risk. You might be right about direction, but wrong about timing. Building positions gradually and managing risk carefully allows you to maintain contrarian positions through extended periods of underperformance. This involves techniques like dollar cost averaging into positions, using appropriate position sizing, and maintaining diversification across different contrarian themes rather than concentrating in a single position. Managing the risks of independent thinking. While independent thinking is essential for wealth building, it also involves specific risks that need to be managed carefully. Being contrarian doesn't guarantee success, and independent thinkers can make expensive mistakes if they're not disciplined about risk management. The first risk is being early. Independent analysis often identifies trends before they become obvious to markets, but early positioning can be costly if timing is significantly wrong. Markets can remain irrational longer than you can remain solvent. Managing this risk requires careful position sizing, maintaining adequate liquidity, and avoiding leverage that could force you to liquidate positions at unfavorable times. You need to be prepared for extended periods where your analysis is correct, but your positions are underwater. The second risk is being wrong about fundamentals. Independent thinking doesn't make you immune to analytical errors, and contrarian positions can be particularly expensive when fundamental analysis is incorrect, because you're fighting both market momentum and underlying reality. Managing this risk requires systematic review processes, a willingness to change your mind when evidence contradicts your analysis, and maintaining diversification across different independent positions rather than concentrating in a single contrarian theme. The third risk is psychological isolation and overconfidence. Successful independent thinking can lead to intellectual arrogance and dismissal of all mainstream opinion, even when mainstream opinion is correct. Managing this risk requires maintaining intellectual humility, regularly engaging with smart people who disagree with you, and being willing to admit when popular opinion is correct and your independent analysis is wrong. The compound benefits of independent thinking. The benefits of developing genuine independent thinking extend far beyond investment returns. Independent thinking compounds over time in ways that create multiple forms of wealth and security. The first compound benefit is improved decision-making across all areas of life. The analytical skills and psychological discipline required for independent investing transfer to career decisions, business opportunities, and life choices that can have enormous financial impact. People who can think independently about markets often can think independently about career opportunities, identifying growing industries or undervalued skills before they become competitive. The second compound benefit is reduced susceptibility to financial fraud and manipulation. People who follow crowds are natural targets for investment scams and wealth extraction by sophisticated operators who understand crowd psychology. Independent thinkers are much harder to manipulate because they're skeptical of claims that sound too good to be true. They do their own analysis rather than relying on other people's recommendations, and they're comfortable disagreeing with popular opinion when their analysis suggests caution. Final thoughts. The choice between comfort and wealth. After 7 decades of investing and observing human behavior in markets, I've come to understand that getting rich requires making a fundamental choice between psychological comfort and financial success. You can follow the crowd and feel comfortable, or you can think independently and build wealth, but you can't do both. The crowd offers comfort. When you follow popular opinion, you feel validated and accepted. When your investments align with conventional wisdom, you can blame others if things go wrong. When you make the same mistakes as everyone else, you don't feel foolish or isolated. But the crowd never gets rich. The crowd systematically buys high and sells low, follows trends after they've peaked, and avoids opportunities until they've become obvious and overpriced. The crowd provides liquidity to sophisticated investors at exactly the wrong times and transfers wealth to people who think independently. Independent thinking offers wealth but requires discomfort. When you disagree with popular opinion, you feel isolated and uncertain. When your analysis contradicts conventional wisdom, you question yourself and face criticism from others. When you take contrarian positions, you accept the possibility of being wrong and looking foolish. But independent thinking is how fortunes are built. Every major wealth creation opportunity in history has required thinking differently from the crowd and acting on that independent analysis despite social pressure and psychological discomfort. The choice is yours, but you need to understand that it is a choice. You can't accidentally develop independent thinking, and you can't casually implement contrarian strategies. Both require deliberate effort, systematic development, and ongoing commitment to analytical discipline over social comfort. My own journey from refugee to billionaire was possible only because I learned early that following the crowd was a guarantee of mediocrity. The people who helped me, the opportunities I found, the investments that made my fortune, all of them required thinking independently and acting on that thinking despite uncertainty and criticism. This doesn't mean being contrarian for the sake of being different or ignoring all conventional wisdom or believing that popular opinion is always wrong. It means developing the analytical tools and psychological strength necessary to reach your own conclusions and act on them regardless of social pressure. The opportunities are there, the wealth transfer mechanisms are predictable, the analytical tools are available. The only question is whether you're willing to think independently and accept the psychological costs that come with choosing wealth over comfort. The crowd will always be there if you change your mind. But the opportunities to build real wealth through independent thinking are limited and temporary. The choice is yours, but choose deliberately and understand what you're choosing.